Hey guys, I want to welcome you to the weekly Wednesday for the Financial Freedom newsletter, where every week, every Wednesday, we delve into something inspirational, motivational, something excerpt taken from the Financial Freedom weekly newsletter. Wherever you are, if you're listening on Spotify, on iTunes, Google, be sure to click the like, subscribe, share, comment. And without ado, let's get into the show. Hey guys, welcome to this week's podcast episode for the Financial Freedom Podcast. I'm your host, Dr. Christopher Liu. As you know, I'm always in the field for looking at the top performer, getting what distinguishes them in their mindset, their abilities, their capabilities, their ability to change the world, getting those insights and distinctions and sharing them with you. So today I'm happy to introduce Whitney Elkins-Hutten, and she's going to be talking all about real estate today. It's a really interesting market with interest rates. I'm really interested and excited to talk about real estate with Whitney. So Whitney, welcome.
Thank you so much for having me on.
Yeah, I know we had connected, and like I said, real estate is one of those traditional asset classes, and it's how I got my financial freedom. So tell the audience your story and how you got started.
Yeah, I got started as an accidental landlord. That's not where I'm at today. Today, I'm the director of investor education at a private equity group called Passi. We have over 1.4 billion assets under management, 3,300 multifamily, 6,600 self-storage, soon to be 30 express car washes. So, but that's not where I started off. I started off in 2002, bought a house with a significant other. And about a month later, the relationship fell apart and everything was under my name, the loan, the utilities, everything. And I was young at that point in time, and stuffed the property full of roommates, completed the rehab myself, and thought I needed to sell the property 11 months later. And it was after I sold the property that I was like, ooh, I think I made my first investing mistake. Because not only had I been not paying for any of my expenses, my roommates had been covering the mortgage, the taxes, insurance, all the utilities. I walked away with $52,000 in my pocket. And I'm like, oh man, how many more of these deals could I possibly do? And spent several years doing live-in flipping and house hacking as the strategy is known today. And then it dawned on me that I didn't have passive income. That was what I was after. And so a friend of mine said, hey, why don't you hold on to one of those properties and put a tenant in it? And I'm like, oh, nuts. That's what I should be doing. So I scaled up to 30 single family properties. And then I had my next level of achievement. I had a baby girl at home. I was married, and I just didn't have the time. I mean, anybody that owns single family properties eventually understands, hey, it's passive income, but it's not passive with your time. And that's when I dove into larger institutional grade deals. Multifamily specifically is where I started. I didn't know if I was going to do it actively or passively, if I was going to do partnerships or what I was going to do. And so I decided to do it all. Really love the private equity space, both as an active general partner, but then also as a passive investor, because it gave me a unique ability not only to scale my income, my equity, without all of that time involvement, but I could also diversify my portfolio away from away from multifamily. I could add in self-storage. I could add in cash flowing businesses like express car washes and not have to be the experts in those spaces. And so that kind of leads me to where I'm at today.
It's really interesting when I look at the history of real estate. Very early on, it was considered a speculative because you had stocks and you had bonds, but now it's like kind of part of the traditional. And, what's really interesting is your journey from, you kind of go through this stage where landlord is kind of like they say tenants, toilets, and trash, and you're wasting a lot of time. And so there's actually better ways you talk about how the billionaires and the top 1% invest in real estate. They look at it very differently. Describe to the audience this idea.
Yeah, I would kind of consider it as a sliding scale, right? You start off investing, and if you start off with the traditional American narrative, go to school, get a job, invest in your 401k, right? And what is available in the 401k? Wall Street specifically does not want real estate in its 401ks because they wouldn't be able to charge the fees it does and, reap all the tax benefits that they do, not the investor. Anyways, so you're fed this narrative. It's no wonder why we grow up and don't know this. And so that's probably your first foray. Anybody listening here is that's their first foray into investing, stocks, bonds, and mutual funds. Maybe a couple notes on the side or something like that. Nothing too crazy or alternative, as they say. But then you hit that level of achievement. Somebody eventually kind of wakes up one day and realizes, wait, how am I going to scale myself, my cash flow? How am I going to be able to retire off of this? And then they might pick up a house, or maybe they convert their current home into a rental, right? They move into a new home and they convert their previous home into a rental. And then the light bulb goes off for them, like it did for me. Oh, I have cash flow. Somebody else is paying down the loan on this property. I'm earning appreciation, and I'm using leverage to maximize my growth. Then you start picking up more homes, and then you're just like, wow, this is very labor intensive. So you might scale up into larger assets, right? It sounds kind of like my journey, right? At the very beginning. But then eventually, and this is where a lot of people that are either high income earners, high net worth individuals, and the 1%, they realize that their time is best leveraged in their job. They have a higher and best use of their time. And it's not painting their rentals or dealing with tenants or anything like that. It is learning to vet those operators that can bring their knowledge and experience, their ability to pull capital, ability to get high quality institutional grade deals. That is where their time is best used. And so they start investing in other people's deals so they can continue, one, to leverage their knowledge and experience, everything that they went to school for, but also create the impact in the world that they want to create. Okay, not everybody's cut out to be a full-time real estate investor, manage a large portfolio of their own active deals, and I think a lot of people jump into the space expecting, hey, I'm going to become that real estate professional. I'm going to do this full time. And then they wake up a few years later going, I like the income, I like the equity growth, but man, this is not fulfilling. And so that's really where the 1%, they realize that about themselves. They know where they're going to create the impact in the world, and they learn how to vet other people to invest with.
Yeah, I love that. And like I said, you can either be fortunate enough, get started in, working with billionaires and private equity, all of the high net worth, family offices, or you have to start out from the ground up, landlord, and but then eventually you talk about scaling from multifamily, apartments, syndication. This is what I really love. And, like if you stay at a Hilton or Marriott, all these places, they have great employees, and the investors, they like I said, like you were describing, it's like they leverage their relationships, their political, social capital, create deals, create value, and work smarter with their time. So like I said, real estate is one of those almost, millionaire, centimillionaire, billionaire has real estate in their portfolio. One thing is talking about, so I want to delve into kind of more current situation, and now is like, where do you see the current market, starting out?
Well, we're recording this June 1st, 2023, and it has been I would say 15 months of a very wild ride with interest rates going up, the Fed raising interest rates. And so if you're nail biting for people, especially if you are heavily invested in real estate, actively or passively. But I think, I can, maybe bust out the crystal ball a little bit and try to give some, demystify the markets a little bit. But really what I like helping people orient around is the principles that will help them navigate their investment, whether the market goes up, down, or sideways. Okay, so let's talk on those principles first, and then let's see where this lines up with the current market. And this is one of the reasons why I love real estate, why I love investing in businesses that own real estate, is because there's capital preservation there. The real estate generally cannot go to zero. There's always value in the land. There's always underlying value in the building, in the business that is sitting on that piece of real estate. So depending on how you're investing in real estate, I love investing in assets that cash flow today. In today's market, with everything that's going on, with interest rates, the current debt profile, everything, because it tells me that there's an element of stability here in that particular investment, and that I could be nimble should I need to adjust to, potential recessionary situation. Like, if I'm investing in multifamily, do I need to hold rents flat for 6 to 12 months, as the market is kind of, doing what it needs to do, in that part of the cycle. Okay. And then I love investing in assets that have equity levers, and the more equity levers you can pull, the better. Do you have a way to decrease the expenses on the asset? And more importantly, do you have ways to add additional streams of income? Now, when we talk about cash flow and equity, you might be able to do that with single family homes, right? But the more units you have in each of those investments, that's why multifamily is awesome. That's why self-storage is awesome. That's why having a portfolio of express car washes is awesome, because now you've got multiple streams of income, multiple streams of cash flow supporting the value of that asset. Not only the cash flow that you can take home, put in your pocket, but the net operating income, the expected gross income growth that actually drives the value of that asset. So the market can go sideways, the market can go down. And if you're investing in an asset that's valued based on net operating income, you can still make money in a recessionary environment. And then we got tax benefits. There's 7 that I love to go through, but I'll just cover 4. I like investing in assets that have tax benefits. And so that's why a lot of us here love real estate, right? We can take advantage of depreciation, accelerated depreciation. We can also take advantage of 1031 exchanges to continue to kick that tax can down the road. And these are the fundamental principles that will help you in your portfolio grow, no matter if the market's going up, down, or sideways. Now, what I challenge everybody is go through your portfolio line by line, each stock, bond, mutual fund, piece of real estate, note you're invested in, and grade them in according to those 4 principles: capital preservation, cash flow, equity, and tax benefits. Now, I'll offer up one more: the quality of the operator. We alluded to that at the very beginning. You have to be with an expert operator that knows their stuff. That's one, a huge thing in today's market to watch out for, and make sure you're invested with experts, because the market's been on a wild ride for like the past 10 years. I mean, everybody has looked like a genius investing in real estate, but you want to make sure that you're investing in a team that has a deep bench background in business, navigating business environments, in real estate environments too. Not just COVID, but before, right? 10 to 15 years, running up to this. Now, to answer your question more directly, where are we in this type of environment? We're still seeing the interest rates rise, with the Fed. I think if I had my crystal ball, I think we could expect them to go up another 1/4 point, maybe 1 or more times this year. Because if you think about it, it takes 6 to 9 months for interest, at least 9 months, I would say, for that first interest rate raise to ripple effect through the economy. So what we're experiencing now is really the work that was done by the Fed mid to late last summer. All right. So I think they're still trying to hold on to this thought they can tamper inflation down to 2 to 3%. But every economist that I study I think, there's 2 things that are happening. One, we have seen some cracks in the economy. I think those rate raises are going to be fewer, and they're going to maybe hold flat by the end of the year, and maybe even start coming down into mid to late 2020. And then two, this is the time to invest with operators that know how to navigate that environment. That if they're investing in a deal that they have put an interest rate cap on their loan, that they have underwritten the entire deal from day one from that cap, that highest cap rate that they can have, that they have money in the bank to pay for the next cap rate or rate cap should they need it in the next 24 to 36 months. So those are just kind of some things that I'd help people, take a look at, but it really boils down to fundamentals.
Yeah, I love that. Like I said, really solid asset class, can do so much with it, like tax efficiency, capital efficiency, wealth. There's so many properties to real estate that make it really. And then, but like I said, you're alluding to, it's not a solo job. You have to have a good team. Otherwise, you're not scaling your time, and you just buy yourself another job.
Oh, I did that for sure. I started off like in public health. Like I have a master's in public health and PhD. I don't use either one of them anymore because I needed to figure out how to scale myself. And I was able to do that through real estate and my investments. But it took me the better part of like 10 years to realize I don't have to do it all. I can find the best of the best and invest with them and scale it that way.
You don't need to reinvent the wheel. What's interesting is that there's a lot of different asset classes. Like, for example, commercial is a little bit riskier because, this whole there's a lot of office spaces empty. People are still paying the leases. They have this debt. If they refinance it, they have to pay more. You have a looming recession, interest rates, a lot of uncertainty. You talk about, for example, a lot of investors I talk to, they talk about multifamily. You talk about car wash, self-storage. Which real estate asset classes do you see performing the best in this sort of environment? Again, this is not advice. This is just your opinions.
Yeah. So again, I like thinking in fundamentals. So what does everybody need over their head? They need a roof. I like multifamily for that reason. Now, multifamily, if you have read any of the market reports by Johnny Chang, one of the VPs of Marcus and Millichap, he had built this immense case why multifamily, even though the cap rates are compressed, cash flow is low, there's still the fundamentals are still there to prop up multifamily for quite some time, at least another 10 years. We're 4.3 million units undersupplied today. Okay, that's problem's only getting worse. Millennials are starting to move out of the urban centers into the suburban areas and forming families. So they're no longer rooming together, with their buddies. They're breaking out into the suburban areas and they're creating family households. So we're seeing a lot of pressure in that transitory environment. They're also competing with baby boomers for the same property. Now, that's going to do a couple of things. That's going to continue to drive up asset prices, but it's going to put down, again, pressure on unit counts. And so we have to start delivering homes faster. Now, unfortunately, with this recession, we've seen a lot of slowdown in construction. And so that's not going to help. It's not, for people who need housing, that's not going to help their situation. For investors that are investing in housing, that will help your investment. And then we have one of the biggest wealth transfers occurring right now. $84 trillion is transferring from boomers to millennials. Now, that projection has gone up since COVID with this injection of quantitative easing. Originally, it was $68 million or $1 trillion. Now it's up to $84 trillion. All that capital is going to need to be placed into an asset. So you're going to have people chasing the same asset with more dollars in their pocket, which is going to continue to drive up asset prices. So that is a great case for multifamily. Now, everybody needs a roof over the head. What is the next thing that most Americans, take care of? They're going to take care of their things and then their cars. And I argue that they're going to take better care of their cars sometimes than the roof over their head. So that's why self-storage, and I think, is a great complement to multifamily, as well as express car washes, because you're tapping into the two things that Americans are never going to give up, and that's their belongings and their cars. And we can spend a whole hour on, diving into the metrics there. Now, I want to kind of put a big a bit of an asterisk on this. We're seeing a lot of growth in some market areas of the United States, particularly the South, Southeast, the Gulf corridor. You're also seeing some exit trends in other areas in the United States. So everything that I just said, you can't just like apply that fully to all areas in the entire real estate market. It's still very regional. So you need to pay attention to where those trends are happening, where are populations growing, where are jobs growing, where are corporate businesses moving their headquarters to, where are tax incentives for business, business friendly, a little bit lower. And so those are the areas in the United States. If somebody's looking to invest, I would really pay attention to those trends in those markets in order to set yourself up for success.
It's really interesting. The more people I talk to, the more it's like there's different pockets and niches and different. It's in real estate is very local, so some places are experiencing boom and some places are stagnant, and then you couple that with what's going on macro. It makes it very interesting, and it makes it a little bit more dynamic and get to be a little bit more flexible. So how do people contact you, follow you, check you out, visit your social media, etc.?
Yeah, I actually make it really easy for people. If you want to reach out to me, go to Passive. Now that's a subpage on our passiveinvesting.com website, but it is the only spot you can get my ebook, Passive Investing Made Simple. You can also get priority access to our open deals, as well as find time on my schedule. And we can.
Yeah. And for all the listeners out there, let's thank Whitney for coming onto the show. Like I said, real estate is one of those traditional asset classes you have to understand to get financially free, financial independence, equities too, bonds as well. And then after that, you can scale it. All of her resources will be in the links and show notes. And with that, thanks so much for coming onto the podcast.
Absolutely. Thanks so much for having me.
I hope you really enjoyed that wonderful, inspirational, motivational piece. Again, wherever you are listening, if you liked it, be sure to like, comment, share, subscribe. We're on everywhere: Spotify, iTunes, Google, Amazon, Audible. And without much ado, be sure to thank this show's sponsors, and we'll see you next week.